Hello guys, and we're back again. Well, this chapter is financial analysis, so we are business analysts, but financial analysis seems to be a bit kind of intense. Let's see though, because we did data analysis, concept analysis, model analysis, decision analysis. Why the fuck not financial? Why not emotional analysis? Never mind. All right, what's the purpose? Financial analysis is used to understand the financial aspects of an investment, a solution, or a social approach. Cost and return, correct? Description, financial analysis is the assessment of the expected financial visibility, viability, stability, and benefit realization of an investment option. It includes a consideration of the total cost of the change as well as the total costs and benefits of using and supporting the solution. Costs and benefits. The change and the solution itself, because sometimes the return is not, I don't know, you might pay $1 million for something that saves you $100,000 a year, but over the next 5-10 years you'll be able to save a lot more money with things that you didn't have to add, right? Like some solutions are a lot more foundational and they cost money now but they support later. I don't know why that came to mind, because I feel like when we're talking about cost versus benefits, sometimes people are very short-term oriented. Business analysts use financial analysis to make a solution recommendation for an investment in a specific change initiative by comparing one solution or solution approach to others based on analysis of the initial cost and time frame which those costs are incurred, naturally. What's the cost, what's the time frame, expected financial benefits and the time frame in which they will be incurred. Again, 1 year, we're making this much money, spending this much, losing this much. Ongoing cost of using the solution and supporting the solution. That's impressive because I think a lot of people kind of forget. Yeah, I built the website, but maintenance is $1,000 every year. So you kind of budget for our website and then you go what the fuck's going on? Risk associated with the change initiative, what are you losing? What are the people that are gonna get upset because of you and all that good stuff? Just the ongoing risks to business value of using the solution, because sometimes some solutions kind of force certain customers to do different things or certain employees to do things different ways. I'm not sure. Just having a conversation with you guys here and reading the book or reading some random stuff. A combination of analysis techniques are typically used because each provides a different perspective. Executives compare the financial analysis results of one investment option with that of other possible investments to make decisions about which change initiatives to support. It could be as simple as I'm investing to make money and it doesn't matter as long as something makes me more money or costs me less. Or it could be as intense as I'm investing in a cultural thing, which means I'm scoped and limited to certain kinds of things. Financial analysis deals with uncertainty, and as a change initiative progresses through its life cycle, the effects of that uncertainty become better understood. Financial analysis is continuously applied during the initiative to determine if the changes is likely to deliver enough business value such that it should continue. A business analyst may recommend that a change initiative be adjusted or stopped if new information causes the financial analysis results to no longer support the initial solution recommendation. Right? Because ultimately when we're looking at the financial analysis, we're trying to validate or verify. And as we kind of move forward, we realize if we're kind of doing the right job or not. And the solution based on financial analysis that should point in the direction of a right solution or just point away from the wrong solution. What are the elements? Cost of the change, total cost of ownership, value realization, cost-benefit analysis. And there's an example of cost-benefit analysis here, super cool. There are financial calculations as well and return on investment. So each one kind of is a different thing. What's the cost of change? It's cost us money to do something from one point to another, to move, right? It's the solution, right? We're creating a solution for something that's there. We are, our business analysis led to this. This has to change, this has to shift. So the cost of change includes the expected cost of building or acquiring the solution components, whether it is we're building a new fucking garage or we're building a fucking software. The cost of transitioning the enterprise from the current state of the future to the future state. This could include the costs associated with changing equipment and software facilities, staff and other resources, buying out existing contracts, subsidies, penalties, converting data, training, communicate the change, the managing the rollout. Every fucking industry has its own fucking shit. What's the cost of ownership? is the cost to acquire a solution and شو اسمه the cost of using the solution, right? There are two different things. If you want to build the fucking solution, like, that's the cost of ownership. If you want to buy a solution or rent it, the cost of ownership. Supporting the solution for the foreseeable future, like, you keeping that solution with you, like, that's you owning the solution. In the case of شو اسمه, help combine to understand the potential value of a solution. Like, that's what you kind of like look at. It's like, I'm paying this much, but I'm getting this much value. In the case of equipment and facilities, there are often generally agreed to life expectancy. However, in the case of processes and software, the life expectancy is often unknown. Some organizations assume a standard time period, for example, 3 to 5 years, to understand the cost ownership or intangibilities. We kind of do that, right? Like, there's also deprecation when it comes to software, but software doesn't kind of like get ruined. Technical debt gets acquired, incremented. And what I mean is, because software is always moving forward, so there's always new techniques, and there's always new, for example, like the software itself, for example, consumes X amount of energy in order to process your work. If we upgrade the software or if we update it, we might that would cost us less. So there are all these things that to own a solution, you have to kind of understand when you can do better, do more, edit, all that, the cuteness. Value realization. Value is typically realized over time. The planned value over the expressed annual basis, or it could be expressed as a cumulative value over a specific time period. The cost-benefit analysis, sometimes called the benefit cost analysis, is a prediction of the expected total benefits minus the expected total costs. Should be clearly stated in calculations so they can be reviewed. Naturally, we're talking numbers here. Challenged and approved, the cost and benefits will often estimate based on those assumptions. An estimated methodology will be described so that it can be reviewed and adjusted if necessary. The time period of a cost-benefit analysis should look far enough into the future so that the solution is in full use. Not all solutions are implemented at once, remember that, yeah? And the planned value is being realized. This will help to understand which costs will be incurred and when the expected value should be realized. This is an example: revenue XXX, year 1, year 2, year 3, reduced operating costs, time saving, reduced cost errors, and then basically annual benefits. What are the costs, cumulative costs? That's how they're doing it, right? And then at the end of it, they kind of like subtract them with each other and go like, yay, we're making this. Some benefits might not be realized until future years. Some projects and operating costs may be recognized in future years. Some cumulative net benefits could be negative for some time until the future. And there's also qualitative. Like, if I am spending a bit more money, but I'm helping the employees that are working with me be more efficient and effective, that's a good cost, because then I measure the benefits based on them kind of like doing a better job. It's not necessarily all numbers. In some organizations, all part of costs associated with the challenge may be amortized over several years. That's the amortized/deprecated, right? That's the accounting term. And the organization may require the cost-benefit analysis to reflect this. During a change initiative, as the expected cost became real cost, the business analyst may re-examine the cost-benefit analysis to determine if the solution or solution approach is still viable, right? Financial calculations. Organizations use a combination of standard financial calculations to understand different perspectives. Just use Google, dude. And how different investments differ and deliver value. These calculations take into consideration the inherent risks in different investments, the amount of upfront money to be investment, because like you kind of like have to plan, you have to prepare, you have to adjust, you have to like project, all that good stuff. And so, interesting. These calculations take into consideration the risk, different investments, and amount of money, upfront money invested compared with the benefits we realize. A comparison of the investments in organizations could make an amount of time on which take to recoup the original investment. Okay, whatever. Financial software, including spreadsheets, typical provided pre-programmed functions and correctly performed with these financial calculations. Fuck yeah. The return on investment is basically like, what are we making out of this? Why are we doing this? The return on investment is a planned change and expressed as a percentage, measuring the net benefits divided by the cost of the change. One change, and the ROI is basically an index, right? Because what you're effectively doing is, all right, this is frustrating me a bit. And remove. Yes, continue. All right. One change in initiative solution or approach may be compared to others, determined which one provides the greater overall return relative to the amount of the investment. Again, like ROI is, I don't know, if it's in percentage, so has an ROI of 10% and this ROI of 12%, yeah, that's a decent number to look at. But what if the ROI of 12% is an extra year's work? Is it worth it? Right? Like there are things to kind of consider beyond the ROI, but like, it's a valid thing to look at. Total benefits minus cost of investment over cost of investment. The higher the ROI, the better it's literally a percentage here. The better the investment. When making a comparison between potential investment, the business analyst should do the same use the same time period for both, exactly. Discount rate. The discount rate is the assumed interest rate used in the present value calculations in general. It's similar to the interest rate that the organization would expect to earn if it's invested in money elsewhere. Many organizations use a standard discount rate, usually determined by its finance officers, to evaluate potential investments such as change initiatives using the same assumptions about expected interest rates. Sometimes a larger discount rate is used for time periods that are more than a few years into the future to reflect greater uncertainty and risk. Discount rates are basically like, you're investing in me now, I'll give you a 20% discount, but you're investing based on the evaluation a year, 2 years from now. When it comes to the present value, different solutions at present, different solutions and different solution approaches could realize benefits at a different rate and over a different time. To objectively compare the effects of these different rates, 1 second. It's not a screen recorder. Browse and play your local music. Vocal recorder. Oh, fuck this shit. Present day value, the benefit of realized sometimes in the future is reduced to discount rate and determine its worth today. Like what we're doing is we're kind of like assessing the value of whatever it is that we're doing today. But I feel like the present value is more from an investment's perspective. So like the financial analysis right now is no longer about a solution. Formula to calculate present value is sum of net benefits for that period plus the discount rate for that period for all periods in the cost multiplied by all periods of the cost-benefit analysis. It's expressed in currency. It's an assessment. It's an evaluation. It's like, how much is this worth as an investment? Net present value is the present value of benefits minus the original cost of the investment. This way, different investments and the different benefit patterns can be compared to, in terms of present-day value. The higher the NPV, the better the investment. The formula to calculate net present value is net present value minus cost of investment. Net present value is expressed in currency. The higher the NPV, the better the investment, naturally, because we're kind of removing the cost. Internal rate of return is the interest rate at which the investment breaks even and usually used to determine if the change solution or solution approach is worth investing in. The business analyst may compare the IRR of one solution or solution approach to minimum threshold of the organization expects to earn from its investments, called the hurdle rate. It's like the break-even point, right? Because like every business has a break-even point on a monthly basis, weekly basis, or kind of like yearly basis. And like IRR seems to be like, when does the investment pay for itself, right? Internal rate of return. Once the planned investment passes the hurdle rate, it could be compared to other investments in the same duration. Yeah, that's kind of like a good time frame. And the IRR is internal to one organization since it does not consider external influences such as inflation and fluctuation interest rates or changing business context. It's based on the interest rates with the NPV is 0. Net present value is 0, which means like based on the interest rates. The payback period provides a projection of the time period required to generate enough benefits to recover the cost of the change. That's where the IRR kind of like hit internal rate of return. Because like here we're talking about like the interest rate of which an investment breaks even. So like when we reach break even, that's the payback period, right? The payback period is the break even point, unless there's kind of like the discounted rate, because if a discounted rate at 20, then break even point is 20% more, right? Should include that 20% discounted. But yeah, the payback period provides a projection of the time period required to generate enough benefits to recover the cost of the change, irrespective of the discount rate. Once the payback period has passed, the initiative would normally show a net financial benefit of the organization unless operating costs rise. There is no standard formula for calculating the payback period. Time period is usually expressed in years or years and months. Amazing. Usage considerations. Financial analysis allows executive decision makers to objectively, what are the strengths? Sorry. Objectively compare very different decisions, because you're working with numbers, right? So you can actually objectively look at these numbers and go like, this is better, this is faster, this is slower, this takes longer, and whatever. Assumptions and estimates are built into the benefits and costs into the financial calculations that clearly stated that they may be challenged or approved. It reduces the uncertainty of the change in a solution by requiring the identification and analysis of factors that will influence the investment. In the context business need, a stakeholder needs change during a change initiative. It allows for the business analyst to objectively reevaluate a recommended solution, 100%, right? So like, reduces uncertainty because it gives you numbers, gives you the assumptions and the estimates that are built into the cost benefits, the costs and benefits basically like structure. So the calculations basically includes all of this shit that clearly states them. If the context, business need, or stakeholder needs change during a change initiative, it allows the business analyst to objectively, right? Objectively is numbers, quantity. Qualitatively is subjective. Some costs and benefits are difficult to quantify financially because financial analysis is forward-looking. There will always be some uncertainty about expected costs. Of course, positive financial numbers may give a false sense of security. They may not provide all the information required because there is also like the subjectivity of it. Yay! Now we're going to focus groups. Amazing. Stop.